Hello, everybody. Rob Barnes, Integrated Insurance Consulting. Today's CFP program is Life by Design, and I'm going to jump right into the material here. So, today's presentation is a new one, and we'll be addressing a couple other parts to it in the future. It's a macro view of where we are in the life insurance industry and a little bit of how we got here. I'm going to go through the evolution of life insurance, and we'll look at a brief historical timeline and compare the past with where things are. I'll address how life insurance is priced and discuss the current options available in the marketplace. And then in the end, I'll debunk a few of the most common misconceptions we see about life insurance. So we start with a timeline that goes all the way back to 700 BC when we know that the first casket kitty was around. We fast forward to the late 1500s and we find the first term insurance contract was issued. And it took almost 200 years later before the first U.S. life insurance company, presented by the Presbyterian ministers, was available in 1759. And another 84 years along the way for Mutual of New York, or the Money company, to be developed. Today, Money doesn't exist in its name. It was taken over by AXA, and AXA is now branded as the Equitable. So you'll find them there, but they demutualized quite a while back. 8 years after Money came into play in the 1850s, we saw Mass Mutual, still alive, current, and vibrant today. And then just 5 years later, we started the regulations with both Massachusetts and New York creating insurance departments. So we're going to take a brief stop at each one of these things along the way. We'll start with this one. Now, for our cat lovers on the call, don't fret. This kitty is on the casket, not in it. But all insurances really are a pooling effect. And what the casket kitty was in the Roman days, when somebody died, others would help pitch in to provide a casket for burial. And we see pooling in every way, but life insurance is different than other insurances because everybody does die. So whereas term insurance is priced whether or not you're going to outlive the period of time, permanent insurance is priced to deliver whenever that time is. So the life insurance conversation is different than any other insurance because death is not an if. So our next stop, in 1583, the first known term contract was issued. William Gibbons was a salt merchant in London, and as part of a business arrangement with a group of merchants wanting him to deliver the goods back to them, Richard Martin had a 1 year term policy issued on him in case he didn't come back with the goods or their money. And unfortunately for Mr. Gibbons, the salt merchant, he died 11 months into the 12-month contract, and for 30 pounds, Mr. Martin received 400 pounds sterling, and this is the first known contract that I was able to find out there. In the past, annual renewable term was the most common life insurance in the start, and as the picture dictates, every year you get older, the cost of insurance goes up. Now, remember this curved grid because you'll see it in other diagrams when we show them to you. Today, though, level term is much more in vogue than annual renewable term. So in this case, we have a 20-year level term premium. And after the 20th year, the premium shoots up dramatically and then increases every year after that. So most term policies, at least older ones, do this at the end of the rate lock. They turn into annual renewable term. And they can get pretty hefty, and most people tend to let them go unless they thought they were dying sometime soon. Now, today, carriers are well aware that many people are buying on price alone, and so they continue to change their portfolio and product design to have a lower price. And so, one of the things that they do to limit their risk and lower their price is instead of in keeping the death benefit the same after the rate lock, they substantially decrease the death benefit after the rate lock period. Some carriers have gone a la carte. So if you want your 20-year term to be convertible the whole 20 years, then you might have to add an extension rider to it to make that happen. And even worse, other carriers are coming out with term that's not convertible at all. So there's no flexibility, no plan B. And since we don't really know the future, I find that scary. I prefer to have flexibility built into their insurance planning as well. And so, um, what happens to somebody in the 18th policy year if their policy is no longer convertible and the death benefit's going to substantially drop and their health has substantially changed? We have had situations like that, but luckily, clients bought quality term and had options to extend the full death benefit beyond the initial rate lock period. So as we go along in our timeline, we're moving forward to 1759. The Presbyterian ministers created the first insurance company in the US because they wanted to protect their ministers' families. So the Presbyterian Ministers Fund was created to provide relief of poor and distressed widows and children of Presbyterian ministers. Now, this plaque that I have on the screen here is something that I've actually seen when I've been in the industry a long time. I've seen some old timers that used to hang this, and we as life insurance professionals used to be known as the widow and orphan's friend because we were protecting them and their future. We go along with our timeline. 1843 brought the Mutual Life Insurance of New York, then Mass Mutual in 1851, and then the insurance regulations. So what I want to opine on a little bit is that, there's two structures of companies out there. There's mutual carriers and stock carriers. Now, just being a mutual or a stock does not necessarily make you good or bad, to be very clear. But a mutual carrier, when you think that all life insurance is based on interest, expenses, and mortality, a mutual carrier doesn't have to feed stockholders and policyholders. They just have to take care of their policyholders. In fact, if you own a participating whole life policy with a mutual carrier, you are kind of considered the stockholder because the dividends come to you when the company makes profits. But I find myself in the last 10 years, as the world continued to change, back in the 2000s, there was a wave of demutualizations out there. Companies needed more access to credit to build their businesses and such. And so just two big names that demutualized back then would be Prudential and Metropolitan. And today, Metropolitan was split off into several companies. The remnant of the life insurance, individual life insurance side is now called Bright House, and it's actually up for sale. And between the two carriers, Prudential has fared very or markedly better than Metropolitan. They're much more vibrant and a lot more sales and stronger ratings and so forth going on. So with that, last 10 years, I find myself gravitating to mutual carriers more than stock, especially for certain types of permanent insurance. So as we fast forward, initially there was only term available, the annual renewable term, and then whole life was created by the Presbyterian ministers. And by its very nature, whole life is scientifically designed to work, and the reserves are inside the policy. You see, the mantra that whole life works under is that the guaranteed cash value is going to equal the guaranteed death benefit. And it's by age 100 or maybe up to age 120 these days. As we're all living longer, we've increased these things out. But if we do the math based on interest expenses and mortality, there's only one premium. Now, not all premiums on whole life are the same, and that's because carriers use different forecasting for the interest expenses and mortality. But it's also true that your total cash is going to equal your total death benefit, assuming you're using the most typical dividend option of buying paid up additions. The death benefit will grow and the cash value will be larger than the guaranteed cash value because of dividends and paid up additions, but those two will equal out at age 100 or 120. So that's just a quick diagram of how whole life insurance works. So let's get back to the history of life insurance and our timeline to start showing when the other policies showed up. So for over 100 years, there was only term and whole life. And then in the late 70s, early 80s, new types of life insurance started to evolve. In 1979, E.F. Hutton spoke and they developed universal life. In the late 70s, early 80s, we were at double digit interest rates. People were taking loans from their whole life policies that weren't yielding double digits for sure. And they were either buying CDs or they were buying some universal life. Some people did a tax free exchange from their whole life to universal. We all thought this was going to be the greatest new thing, but then interest rates started to fall and they fell for roughly 2 decades. And we were at a very low period of interest rates up till about 45 years ago. And so looking back, with hindsight, some people might have been better off keeping their whole life policies as long and short of it. But as the interest rates were coming down, we were in a bull market. And in 1986, the Equitable developed variable universal life. Now, your cash value could be invested into the stock market and earn stock market type returns via the sub accounts involved. And then Transamerica, a while later, invented indexed universal life. This is the most popular, most pushed permanent life insurance chassis in the marketplace today. Many people don't understand it well enough, including those selling it, is the way that I would tell you. And very simply, it looks that we can protect your downside with no losses, and you can participate in market-like returns. And although there have been stretches of time when an IUL can outproduce a variable, in the long, long run, you wouldn't expect it to. And then in the 90s, secondary guaranteed universal life, or GUL, guaranteed universal life, was developed. I think the company was AIG. I'm not 100% positive about that, but I was around. I remember it and all that. I remember competing against it when I was with a whole life carrier. And today, AIG has branded and twisted off from the huge AIG International, and they're branded as the Core Bridge right now. So a little bit of uptake or update on the name changes and mergers and such. So again, going back to the 1979 era, a universal life requires the mantra it works under is that as long as there's money in the bucket to pay the cost of insurance charges, you're okay. But again, the opposite of that, if there's no money in the bucket, you need to fund more premiums to keep things going. And this COI hole in the bottom of the bucket is getting bigger as you age. And so we know today, because a lot of people bought Universal Life many years ago, they've been paying on it. They haven't pulled it out of the drawer and updated it. I hope you're doing that for your clients, because many of them are grossly underfunded and they're going to crash and burn unless they get more funding. And unfortunately, the client did their part. They paid all the premiums, or at least they did part of the part they might not have remembered or never told. You have to monitor and maintain this policy. There's moving parts. It's not etched in stone. And even though you don't control the performance or the mortality part, you hold them in a universal policy. So you can pay your premium. So universal life has two sets of mortality within it. So if you always see the current cost of insurance at the current rate that they're paying, and then if you look at ledgers, it'll show you the guaranteed cost of insurance column at the guaranteed rate of return. So in a lot of universals, there aren't a lot of regular universals left in the marketplace, quite frankly. You're generally seeing a 4 or 5% yield on them today, and they might have a minimum contract of 2 or 4% for the life of the contract. But they added flexibility, but they also added risk with these kind of policies. So, anyway, we'll move on here to the next thing. So, when we look at variable universal life, it's the same chassis, but a different engine. And you'll see in a few minutes, we'll start breaking down things. You start with the chassis and then you discuss the engine of what you're trying to do with your life insurance. And I'll give you some more insight on how to design a permanent plan if that's what's of interest to you or your client. So again, back to the mid 80s, interest rates falling, a bull market going on, variable life introduced, and we were showing 12% returns at that time. Now, the problem I have with a indexed or a variable universal life policy is that we're projecting a rate of return each and every year and essentially showing a compounding effect, but the market is not going to yield the same thing every year, right? It's going to be all over the place. And even an indexed universal, they might be forecasting at a 5 or a 6% these days, but you're going to have lower return years. You're going to have zero return years because the market was either down or negative, and you're paid some return based upon an indice in indexed universal life. So think of where we're at right now. We went from something totally scientifically designed, whole life. Now we have even more risk in our policy with a variable life insurance. We have a hole on the bottom that's getting bigger. We don't know what our returns are going to do. And again, all we as an insured, all we control is the premium payments. We can allocate and reallocate and diversify our sub-accounts, but we don't know what they're going to return. And the carrier may or may not increase their cost of insurances down the road. Think of COVID. A number of carriers have increased past and current products as far as mortality costs because of that environment. So when IUL came out in the late 90s, it again was marketed and pushed by many carriers, misunderstood by many of the agents. And a lot of people were telling you it was even better than variable life because you don't have any of the loss years. And again, there's stretches of time when it can outperform variable, but just logic and reason tell you that, if you're in the account versus getting interest based off on a percentage of the account return, you're going to do better in the long run. But all of this gets back down to what are we doing here? Are we protecting or are we accumulating or both? And what's the end game? It's always important to keep that in mind when designing permanent life insurance. So again, just comment again on these illustrations that show a compounding effect. In one of my latest newsletters, we did show, because some carriers allow us to differ the rates of return in the software projections, and you just add a zero every 5 years in an IUL or a VUL, it changes the numbers dramatically the farther out you go. So people didn't like these universal life policies. They came from a whole life, stodgy but guaranteed and reliable and all that. And all this flexibility and the falling of interest rates and the crash of the market in 1987. That's why guaranteed universal life came about. Now, guaranteed universal life is a formula-driven approach. It does not work on the money in the bucket mantra. In fact, it doesn't matter if you have money in the bucket with a guaranteed universal life. If you're looking at a ledger, the way that you know that you're looking at a guaranteed universal life is under the guaranteed columns, you'll see a cash value that usually is a hill. It'll reach a pinnacle, then it'll dissipate and disappear. In the long run, you'll have zero in your cash account, but you'll see a guaranteed death benefit. Now, think of what other life insurance product has no cash value, but a guaranteed death benefit. That's term insurance. So it's been coined that guaranteed universal life is permanent term, right? What we don't like about term is that it ends before we might want it to still be around. And so we can design guaranteed universal life to be guaranteed to X age or Y year or till the day you die, whatever design the client's looking for. So these mortality charts, mortality and expenses don't matter for a GUL as far as the insured and owner is concerned. As long as they pay premium X, the death benefit is guaranteed based upon the different design. But if they start skipping premiums, or believe it or not, some products are sensitive to receiving premiums before they do. Otherwise, in other words, they penalize you if you give them too much money too fast. They don't have places to invest it fast enough. So we can design a set premium knowing based on how long we want the policy to last, including all the way till your death, no matter the age of your death. So these are the different chassis. There's different variations of them, and we'll look more in a couple of minutes at that. But I want to pause for a second. If you came in late after the opening, we need you to log 50 minutes on your on our software here. And if you came in a little late, please stay through the Q&A. We'll have about 50 minutes presentation, then Q&A. Add your questions to the Q&A box. If I don't get to your question today, I'll answer it in the coming week. And likewise, we appreciate you when you close out. We appreciate you filling in the survey, but at least put your CFP code in there or tell us if you're not a CFP so we don't delay proper filing. And if you don't have time to do anything, you got to run out right after this presentation. In 24 hours, you'll get an email asking you to complete the survey. So obviously ignore it if you filled it in or fill it in tomorrow if you don't have time today. So thank you. Back to the presentation. So there's three risks to a policy, any policy. There's payment risk, performance risk, mortality risk, and certain policies leave the client holding all three risks. Other policies only put payment risk on your policy. What can we do to minimize or eliminate payment risk? Well, we can single premium a policy. We can use electronic fund transfers as long as you have money in your checking account. It's their fault if they don't timely take the premium, and sometimes drafts are not done in timely and they come back and draft 2 months after the fact. But this is how the different chassis work. It's the risks and something to be aware of when you're designing life insurance. This is an old article that I wrote for one of the Advisor Today magazine or something like that, but designing the right policy. You know, I hold the CLU designation, which stands for Chartered Life Underwriter. We used to be known as life insurance experts, if you will, or professionals. We used to be known as field underwriters. So I'm part doctor in addition to other things that I do here to know. And so the big deal is here, it takes money and good health to buy life insurance. So we have a process which I'll share with you later, but we don't like to quote any life insurance for anybody until we know what your health is. Pre-screening the health allows us to manage expectations, show expected pricing, and it helps with the carrier selection. Underwriting is not equal. I'm on staff at an insurance brokerage operation. I meet regularly with the carrier reps from all these carriers. Everybody's great, right? But one carrier does well at this condition and the other carrier does better if you're smoking something, So that's what the intellectual property is, if you will, and the experience factor of what we do and how we get things. It's a matter of getting the right fit policy to your clients. So we ask their health. Then it gets into how much life insurance do you want? How long do you want it? How safe do you want it to be? How are we going to fund it? Those are all questions to ask in the design of life insurance. So moving on, again, there's only two types, two categories of life insurance. There's temporary or term, and there's permanent. So again, a lot of people interchange whole life with permanent. And whole life is a flavor of permanent. So under the temporary side, we have annual renewable term, 10, 15, 20, 25, 30. There's even 40-year term out for younger people. And there are a few companies that offer odd year stuff. So we could have an 18-year level term if that's how long's left on your mortgage and you're buying coverage to protect there. So when you the best way to understand term versus perm is renting or owning a home. When you're renting, obviously you don't build up an equity, but if you have quality term, you might consider it renting with an option to buy in real estate terms, or in financial terms, you might consider it an option to buy permanent down the road at a known price rate. So, having quality term provides flexibility and options down the road, and your clients won't get cornered if things change. I understand the thinking with a lot of people about, you're going to have a mountain of money, you're going to have the house paid off, the kids are going to be gone and all that, so you won't need life insurance, but we'll address that a little bit more in a few minutes. So today, there's people buying cheap term that's going to corner their client and maybe sentence them to term for life. And I've seen a lot of situations through my years where that's, corners a client and they're stuck and they don't have a choice, if you will, or any options. So permanent policy, we look at the chassis first. We could have a whole life chassis. You can see my picture there. That's the Hummer truck that gets over any kind of financial strain or stress. A whole life policy is considered a bond alternative. It's an uncorrelated asset class. It rises every year, no matter what the market or interest rates are doing. Your UL and IUL designs might be considered a Toyota Camry, if you will, an everyday car that gets you to point A and B and gets good gas mileage and all those things, but you can't put those in a drawer and forget about them. They have to be maintained and monitored. And then VUL, you might liken to a Ferrari or whatever picture of a car that is that we have on here. And it can do well, it can compete with other things. So you pick the chassis first and then the engine. Now, not all chassis have every engine available these days, but the bank chassis would be a UL kind of a thing where the carrier determines the rate of return you get this year, kind of like a 1-year CD, and they renew that over time. Or it's the participating side of a whole life policy where you're going to get dividends based on the profitability of the company. S&P 500 indexes are what IUL work off of. You're never in the market, but based on the performance of an indice with caps and participation rates and all these things, you'll get credited interest rates. And so for whatever it's worth, to expect an IUL policy to do anything more than about 2 points better than a UL, that's the real way to think about it. Again, there have been stretches when it's beat VUL, but it's not the same thing. If you're really looking to use life insurance as an accumulation vehicle, as a Roth alternative, as a legacy tool with great growth, then you can use variable universal life. A little bit more coming on that in a few minutes. So, what chassis do we look at if we want projections versus guarantees? Well, if we're projecting, we can use a regular universal, a regular variable, or a regular IUL. If we're guaranteeing for a short period of time, we could use term, Otherwise, we can use whole life or put a G in front of any of those because there are variable and index products that have guaranteed death benefit riders. You can guarantee them for a certain period of time or all the way till when the client dies, and understand when you're adding that in, there's a cost to it, right? Because it's an added feature. You ask about the chassis first, as we said, and use the right tool for the job at hand. Pick the right engine or the engine that you're looking for as far as the growth in here. And, this is the choices, flavors, and mixtures of designing permanent life insurance. So, when we move to what's the purpose? Are we trying to protect? Are we trying to accumulate? Are we trying to do both? I know that there's a lot of people in my industry that push indexed universal life as the, savior of the life insurance world and better than any other chassis. But I saw that with variable, I saw it with UL, and I see how things have turned out. So it really is. I think it's hard enough to have people keep their policies in force until the day they die, let alone trying to take some money out of the policies along the way and maintaining and monitoring the policy. Because, what a lot of people forget to tell clients when they're showing these retirement supplement designs to people, they forget to tell them if this policy ever lapses, you're going to have a retroactive tax nightmare. So I want to know going in, as Stephen Covey teaches us, begin with the end in mind. Are you buying this for death benefit protection? Are you buying it for accumulation, of course? Do you want to take money out of the policy later? Do you think you might? Because we want to address the different design problems of projections versus guarantees. And so this other question is something that I ask people. Do you want any coverage to be there when you die, no matter the age? Now, I ask this when I'm discussing term insurance. This is not any kind of segue question to spin them over to a permanent policy. I just need to educate the clients that there's strictly term, there's quality term, and there's term with more. And if you're not sure that you might want coverage longer than what we're locking in today, if you think things might change and you might want coverage longer, then we might want to mix some quality term into the design of protection that we're setting up for clients. So let's, again, if you have questions, put them in the Q&A box and we'll carry on here and we'll get to our misconceptions of and insights. So the further out I am from school, the more I find myself looking up definitions of words to make sure that I'm interpreting them correctly. And so, of course, we don't go to the dictionary more anymore. We just Google them. So these are my definitions for misconception and insight. A wrong or incorrect understanding or interpretation is the misconception, and the insight, the power or act of seeing into or understanding a situation. So, I have something that we call integrated insights, where we add some more understanding to life insurance. As the people on the call, there's licensed and unlicensed people on the call, and the bottom line is. Not everybody understands life insurance like others. I know fewer are selling life insurance, fewer are able to sell life insurance, and it's good for people and organizations like me. But for the future, it's hard to keep track and be good at everything that you have to do as a financial planner. So, these are the four reasons for misconceptions: cognitive bias, limited info, emotional influence, and intentional manipulation. And regarding life insurance, so one example of cognitive bias is some people think you should never buy whole life insurance, right? And then I find a lot of people these days suffer from limited information, so much to know. And I believe that some advisors out there only ever recommend term because they don't understand or feel comfortable enough to talk about permanent insurance. Or the fact that life insurance pays a commission is upsetting to some people, and that alone is not a reason to buy or not buy life insurance. The hard reality of today is there's very few viable commission-free life insurance options available. And so I continue to monitor the situation. And, in the last few years, we had TIAA pull out of the commission-free life insurance world. Haven Life was a fully owned subsidiary of Mass Mutual, a direct to the public, term only, commission free product, and they shut down after a few years. And so that tells me that, as we've always known, life insurance needs more help. You need a life insurance expert often to guide and educate and develop what it is a client cares to have. And so there is one exception to this commission-free arena that's out there, and that is that in the variable life world, there are carriers who developed an RIA platform. So if you're not licensed, you can go to one of these carriers, have your client create by variable life, and you can have an AUM trail built into it to manage the different sub accounts for them. So you don't have to be licensed, they are. And I find these used more than anything by high net worth people where they're already max funding everything qualified. They still have more income they want to save. It's used for legacy planning. We have a large case going on right now where we referred them to a private placement situation. Client's worth $50 million dollars and is a hedge fund manager himself. And he won't accept the lower bond alternative returns of some fixed insurance. He wants to load the bucket and make it a tax deferred, tax free to heirs bucket of money for legacy planning. So those are viable things out in the marketplace. So if it helps, I like to think of the commissions as a payment for implementing the protection part of your plan. As we know, no matter how good a plan is, it only works if it's properly executed. So I get paid when your clients get protected is the long and short of it. So there's certainly bad apples in my business. I know that and recognize that. And again, I'm not a big believer in the supplemental retirement income thing for life insurance. I think there's better uses for it as a legacy plan or a longevity plan or a long-term care plan. We'll comment more in a minute, but the answer is not never permanent, just like it's not always permanent. So amount trumps kind any day of the week as far as designing life insurance. I need to worry about today first. I'll worry about tomorrow. But I know too many people in my business push permanent to people that don't necessarily need it or can't afford it and such. But there's too few people in the commission in the fee only world that never recognize or recommend permanent to their clients when sometimes that might be a good thing per the plan and the goals. So, misconception number one, never buy whole life insurance. Well, first of all, I want to make sure they mean whole life because, again, a lot of people substitute, they use whole life for permanent. So, there's only term or permanent. Whole life is one flavor of permanent along with UL, IUL, and so forth. And I like to know where they got this info. Who told you this, or why do you believe this? In other words, I'm trying to just understand what they do or don't see correctly and educate accordingly. And I can just tell you that you've heard that children's story, the tortoise and the hare, right? Well, whole life is the tortoise, and we know who won the race. So some people poo-poo whole life because they're not necessarily doing risk management, they're doing investment analysis. So let me just state this now and clear. You may or you may not outpace one of my life insurance policies. We won't know until we have hindsight. There's a lot of variables missing. When does somebody die? What rates of return are you actually earning versus it? So, in the long run, a fixed life insurance policy death benefit delivers around a bond alternative return somewhere between 4 and 6%, up to their life expectancy and beyond. For some chassis, it can fall a little bit after that if they live too long. Others will maintain that. So it's just how it works. So this article, Integrating Whole Life Insurance into Retirement Income Planning, is from Wade Pfau. We share this in our kit along with a copy of this recording. And the only thing, his idea, which I concur with 100%, is that, hey, if I'm an older couple and I'm in my 80s now and I bought this whole life a lot of years ago, my assets are going down. Maybe I want to reach into a whole life policy to get some supplemental retirement income now. Not in my 60s when I've got a lot of years left after that to worry about, but as a longevity play. Maybe I annuitize the policy, or maybe I keep this policy and use it as a permission slip to annuitize some other chunk of assets and increase my income because I didn't do as well as I thought I was going to do at this point in time. And then, the idea of adding a long-term care rider, Wade doesn't use that in his article, but I add that on that I believe the future of long-term care planning is a life insurance policy with a long-term care rider. Think of it, it's a known outcome. We know you're either going to die or you're going to need care or a combination of the two. So, think about your clients in their 40s instead of overly overfunding their 401ks and ending up with more money than they'll ever spend and it getting tax bad. Maybe we divert some along the way towards this asset class of permanent life insurance. Again, the time to the chassis is based upon the goals here. So, um, buy term and invest the difference. Been around a long time. There was a company called A.L. Williams. Today they're known as Primerica. They use this and preach this to all their advisors. So no matter what your whole life is or your policy, they'll tell you it sucks. They'll replace it, put a term policy there. Their term isn't all that competitive. And then they often forget to get the side fund going for you, or they use some pretty heftily funded mutual funds that they offer there. It's just bad. It rarely works. It's not a guaranteed thing. And when you compare it to permanent, why not overfund a UL or VUL and use that tax deferred, tax free wrapper called life insurance? That would generally turn out better for people. So, or our insight number two for creating a Roth versus life insurance. Some people earn too much, they can't have a Roth IRA. I know some people are doing conversions, and I understand the values of that if things work out as planned. But back when I was a younger lad in this business, the modified endowment contract laws came into place. We used to take $99,000 and plump it down into a $100,000 death benefit policy. So the charges for the risk was only the difference between that $1,000 of 100 death benefit and 99 of cash. And the government saw that as a tax avoidance thing. That's why they came out with the MEC laws. So you can't put $99,000 into a contract, but you can still get a considerable amount of money into life insurance and not MEC it. And if you're using it as a legacy plan, then a MEC doesn't matter. A MEC is only an issue if you access the cash value during your lifetime. So that case that we're doing private placement in New York, we're looking at $1 million premium over the next 7 years into the policy. And we want the minimum death benefits, maximum growth. As the cash grows, the death benefit has to grow with it. They have to keep a differential between it. So again, I mentioned earlier there are fee-only and RIA options in the variable universal arena. So if your client's making a lot of money, looking for other tax advantage places, wants some death benefit, needs some death benefit, you could look at those, and we can direct you to those places or work with you if other chassis are preferred out there. So one last thing on this, just think about accumulating money in non-qualified accounts. You put it into a mutual fund that has a star go-go manager. The manager retires, the fund returns, starts suffering. Now you want to switch that fund. Well, that one switch is going to cause a capital gain tax. And if you were in the wrapper of life insurance growing tax deferred, that wouldn't be an issue. There'd be no taxation. So the insurance costs are often overcome by the tax advantage when you're using it and funding it for high cash growth, to be clear. Next misconception, the words need versus value. So I understand that a lot of cases come to us. My client needs this, and we're here to implement what you tell us to implement with your clients, no doubt. But the thought, and we're going to include this article in your kit. It's an article I wrote for the NAPFA magazine quite a while ago, but the theories again, my client's going to accumulate a lot of money. My client's going to have their home paid off. My client's going to have the kids out of the house and they won't need life insurance. So we only need term for 20 years and then we'll get rid of it. Well, stuff happens, things change, and sometimes the plan doesn't work as you thought. So I think that needs don't necessarily disappear or dissipate, they change. Especially for better to do people. What today is income replacement, tomorrow might become business continuity planning insurance. For those doing well, it might help go pay for their estate tax, or they just might want to start accumulating assets outside the taxable estate and avoid a heavy income tax on the trust because you hit the top tax rate on trust pretty quickly. So these are all reasons when life insurance might not be needed, but it might add value to the situation. So when I'm working with clients, we address their needs and anything that they're looking or wanting to have. And we have stories, of high net worth people putting lots of money into the asset class of life insurance because they understand all the value to it. So anyway, we move on. Our insight here, you won't need or you don't or won't need it down the road. We'll share this Ernst& Young study with you along with the Wade article, and it just recognizes that essentially some permanent life insurance in the plan can enhance many client outcomes, and it can be used for income replacement, liquidity, long-term care access if you have the rider on it, cash value access. If you had a bad market year, you might access the cash value so that you don't have to realize losses. For those with business or estate planning concerns, equivalency of dividing up the estate or estate income tax or so forth, or estate tax, I should say, you might still value some life insurance on hand. And lastly, I want to bring up misconception number 4, shopping on price alone. Again, we like to ask, do you want any coverage in place when you die, no matter the age? Because this helps them understand there's different flavors of term insurance. You can have strictly term, you can have quality term, or you can have term with more. And term with more includes a rider that protects for chronic illness later on. And so I call that the what if, when what if becomes what now. So I was at a NAPFA convention in a long-term care presentation by somebody else. One of the attendees asked, what do we do for our younger people who aren't really ready for a long-term care solution, a permanent one, but what if they have something happen to them? And I wanted to mention, again, there's a couple of carriers that have these riders on term insurance. That's a way to protect for what if becomes what now. It's the difference of that car crash and being waist down or neck down, paralyzed from it. If you're neck down, these things come into play. So I'm going to wind up again. Add your questions to the Q&A box. I'll get to them shortly. But to just let you know, today is educational. If it's the first time you've been on a call with us, one, thank you for showing up. We appreciate your feedback in the survey and such, but we want you to know that we have a dedicated process of engaging advisors. We've only worked through advisors the last 25 plus years, help you serve your client protection needs. And as advisors went to, or as agents went to advisors and advisors, fiduciaries, we do more and more on behalf of advisors to play the role of agent and consult with the client and so forth. So you send us a client who needs this, we're going to go get them the best this there is. We're going to pre-screen them, show them their options, and we can consult with you or confer with them as you like. You're not really sure what their needs are or you want some help, we can talk with you through the plan and look at all protection options, or we can consult directly with your client. But from there, we will implement the application underwriting and deliver a copy of everything to you. For your clients, this is our standard practice is we pre-screen their health as step number one, and then we educate and design. We find the right fit product. We get the application underwriting and policy placement. So hopefully, I've shown you that the beauty of life insurance is in the eye of the beholder. It's simply a tool. It's a tax advantage tool. It's a leverage tool. It's a liquidity tool. It is the financial foundation of financial planning. It's the Swiss Army knife of financial tools out there. It can add flexibility and confidence to the plan. And if anything, I hope that you recognize, in life, there's only three options. You're going to live, die, or become disabled. And people fear dying early, living too long, outliving their money, or getting sick along the way. A life insurance policy with the appropriate riders and design can protect for all three. So the life insurance conversation is different than any other insurance conversation you'll have with your clients because everybody dies. There's a picture of my mug. I'll get to any Q&A here that there is. Let me find that box here. I want to thank you all for sitting in with us. This is our last presentation for the year. We'll start up again in the spring. And we're looking to have some guest speakers in the fall next year with some insurance-related topics that help you. And anyway, just letting you know that. I wish everybody a Merry Christmas, a Happy Hanukkah, Happy Holidays, whatever you do out there. So again, if you come in late, stay on so you log 50 minutes. If you've logged 50 minutes, you're free to go. Please fill in a survey or at least your CFP code. If you can't do it today, you'll get that tomorrow. So let me get to our Q&A here and answer these. So in 1 second, I'm going to stop our recording here.